Everyone, we are group 7. We're going to be going over an analysis of ATS automation. So just to jump right in, we are given a buy recommendation, an upside of 27.55% based on our target price of $53.44. First off, we went into kind of a macroeconomic analysis of the factors that we think are driving a secular shift to onshoring, which is characterized by like supply chain localization. So we have kind of ABC there, which we'll get into later. And this is coupled with our kind of main investment theses, which we think ATS benefits disproportionately compared to peers due to kind of like augmented end-to-end capabilities and superior moat. So going over just a brief agenda, we'll get into company overview, industry overview, macro analysis, strategy analysis, which encompasses our first thesis, financial analysis, and then our valuation, followed by risk and catalyst finally. So just to hop straight into the company overview, we see ATS, founded in 1978, is a Canadian-based automation provider. Like I mentioned, their main primary source of revenue is their end-to-end manufacturing solutions, and their subsequent is post-automation solutions, comprising 30% of their revenue. Just to break it down quickly, we have life sciences, which is their primary proportion of revenue at 50.2%, followed by transportation, consumer excluding food and bev, and energy. And then looking kind of just on the right-hand bottom here, we kind of have their geographic segmentation in terms of North America, Europe, and then what they call Asia and other. And then capitalization, we kind of just have some market data on the top, and we can see their enterprise values nearing $5 billion. Just going down here into the industry overview, I'll pass it on to Fishman.
Okay, hey everyone. So just to jump quickly into our industry overview, we essentially just wanted to kind of quickly go over the end market automation industry and kind of talk a little bit about the segments, as Declan mentioned earlier, are kind of the main components of the revenue for ATS automation. So as Declan already said, there's basically life sciences, which is the biggest component, transportation, consumer, not including food and beverage, and then finally energy. These are kind of comprised. So first, life sciences is comprised of medical devices, pharmaceuticals, chemicals, just working along this value chain, basically automating everything, making it move a little faster, lowering that defect rate. For transportation, this is electric vehicles, automotive, and the aerospace space. Consumer X food is warehousing automation, cosmetics, electronics. For food and beverage, it's processing, packaging, filling of fresh produce. And then finally, energy is both nuclear power and solar power. So just some quick notable trends we want to talk about is that essentially the global automation software spend is supposed to be around $42.6 billion by 2025. And another thing we've realized from 2020 to 2021 is that 40% of companies worldwide have increased their automation usage. So just quickly to talk a little bit more about the industries, we decided to do a Porter's Five Forces analysis. Something I'll say kind of quickly is that this industry is very niche that ATS is kind of operating in. So it's kind of important to know when looking at the industry as a whole based on how ATS basically operates. So first, we're looking at the customer bargaining power. We know it's very low because obviously automation is something that's very important, as well as I talked about before, kind of lowering that defect rate, increasing the operational capacity of these companies. So customers are definitely needing this automation. Supplier bargaining power is moderate. There's kind of a fragmented supplier base we're seeing with high optionality. So obviously lots of different choice for ATS and for different companies within this industry. But again, there's kind of high switching costs associated with this. Competition, again, as I mentioned, this is a very niche industry. And so there's not a lot of direct competitors that ATS is kind of going head to head with. So we think this is very low. Threat of substitutes, again, very low. There are not a lot of direct substitutes for the actual automation industry itself. And threat of new entrants is also incredibly low, just based off the high startup costs that are kind of necessary to meet the industry requirements. So based on all these factors, we think that the automation industry, and more specifically what ATS operates in, is a very attractive market to kind of get into. I'm now going to pass it off to Param to essentially talk about our macroeconomic analysis.
Yeah, just diving right into the macroeconomic analysis. Initially, first, we wanted to touch on a couple of the drivers that are increasing manufacturing firms' demand for automation. Automation essentially allows these firms to increase the standardization of their manufacturing processes, and this helps reduce their failure rates. So car companies and car companies like Ford have to recall less vehicles as they're able to increase the standardization and increase the effectiveness of their manufacturing processes. And obviously this is a very coveted feature of automation. In addition, automation also helps lower the time to market and lead times, helping customers meet their own customers' demand more effectively. And lastly, they're also able. Automation also helps increase efficiencies, and that helps drive higher operating leverage and margins. Now, just to touch on a little bit of the macroeconomic factors driving onshoring, we're seeing geopolitical risks around the globe. There is a lot of protection. There's been a hike in protectionism, and there have also been increased trade tensions. And so this has increased the risk of internationalization for a lot of manufacturing firms, and having the manufacturing factories across in different countries just increases volatility of the results. In addition, the longer supply chains that we're seeing across the world is actually contributing to supply chain disruptions, as we've seen now, and that's spurred higher demand for local manufacturing processes. And lastly, because of the high consequences of failure, manufacturing firms want more control over their entire manufacturing process, and so they want to bring it back home and be able to exert that control and monitor quality. On the bottom, what we're trying to highlight is that even though disposable income growth fell after stimulus payments slowed down, domestic manufacturing orders continue to stay heightened, and so we do believe that this increase in domestic manufacturing will continue to be a trend going forward. What we basically want to highlight here is that there is a very tight labor market right now, spurring automation demand. What we've seen over the past few decades is that after every recession, job openings rates increase as unemployment rates decrease, such that a company to put out more job openings to fill a single position. We've seen that trend break after COVID, though, because even though job openings rates have increased, the unemployment rate hasn't fallen with it. And so because of that, what we're basically seeing is that companies need to put out even more job openings to fill a single position, driving higher competition for workers. Next slide. And this is just helping us explain why we think this is going to continue. We're seeing historically low labor force participation rates, and at the same time, what we're seeing is that the number of people that are out of the labor force and want to come back in are at the historical trend. So we don't anticipate the labor force participation rate to increase substantially anytime soon. And because of that, combined with high economic growth, the actual hourly wages will continue to rise, further increasing demand for automation and decreased labor intensity. Now, just moving on to strategy analysis, we're just going to be diving into what ATS does best and why we think they're going to be the primary winners in this space. Next slide. What we basically see in this entire automation industry is that the entire value chain offers manufacturing and installation along with after sales service, but ATS also helps provide the design of those automation processes as well. And this allows them to retain their IP, provide similar products to companies within the same industry, while being able to increase their value add services and thereby attracting more demand and more market share. ATS is a perfect combination of this full functionality and scale. It's not the biggest like Rockwell Automation, but it is the biggest in that end-to-end automation of those end-to-end automation providers. It's a market leader there, and so we think that because of its strong track record, it will attract more and more players. And this is just a funnel explaining how companies select their automation providers. Essentially, what we want to highlight is that companies want to look at who has the technological competence to meet my demands. Which one of those companies has the track record of providing effective solutions, and who can make sure that it's stay within budget. And ATS has a 40-year-long track record of doing so. That's allowed it to become a market leader in the end-to-end automation industry, and we think that trend is going to continue. Lastly, we just wanted to comment on the fact that ATS has a lot of exposure to niche markets. It mainly focuses on industries with high consequences of failure, like life sciences, which are also regulated, which decrease the ability of companies to invest in, which decrease the ability of different companies to enter the market and compete with ATS, taking market share away. This high regulation helps ATS build a recurring revenue base, while at the same time, since these industries are also higher growth, it allows a company to grow faster than peers and disproportionately win.
Perfect. Thanks so much, Param. So let's get into financial analysis here briefly. Hopping into the first slide, we see industrial machinery and equipment, just a disaggregation of the ROE. And then on the bottom of the screen, we have ATS Automation's ROE disaggregation. So really the main takeaway is, ATS their ROE has kind of remained lower than industry standards, and this is primarily driven by kind of lagging margins. You can see kind of the profit margin has consistently been lower than peers in the industry, while it's also kind of growing at a lower pace, dragging down ROE as a result. So the asset turnover and leverage, again, you can kind of see it's relatively consistent with industry data. So let's hop into more of kind of on the credit analysis side. So on the credit analysis, we can see on the left-hand side of the screen with the liquidity, there's kind of been a recent drop due to like ATS registering a large unearned revenue amount over the past year, which has kind of dragged down their current ratio. And this is kind of course, symptomatic of their contract structure, where some of their contracts are paid upfront in cash, like as in this case, while some are kind of, paid on account, as is typical. This is coupled again with kind of a lower cash balance in that sense, resultant of a lot of the restructuring and M&A activity that we've seen them, in the past year. And then kind of on the right-hand side of the screen, we have their solvency analysis. As industry leverage is falling, you can kind of see on the top right, ATS has continued to maintain relatively stable leverage with similar debt loads through time, which we see as a benefit to ATS. And the firm's rapid M&A strategy also kind of contributes to this and has resulted in, lower multiples. So I'll just pass it off now back to Ram for our evaluation.
Yeah, actually, so basically to start off our valuation, we decided to do a comparable companies analysis. So on this, we kind of decided to look at two tiers of comps. So the first is actually our direct comparables, which we think are companies that are basically the best match for this end-to-end automation that ATS does. And the second is essentially just two companies from the general automation industry itself. So the first thing I kind of want to say, as we've mentioned a couple of times throughout this presentation, is that there are not many public comparables, and especially those there are not that are direct comparables to ATS itself, just based on the niche market that they kind of operate in. So that's something that's kind of important to think about when looking at this comparable companies analysis. But if we are looking at basically, if we look at our tier one and based on our tier two as well, ATS is trading at a discount on both a PE and an EV to EBITDA ratio, kind of hinting that they're definitely undervalued a little bit, which leads into our DCF. And we kind of believe that this discount in the comps is basically due to just lower margins and a higher debt load.
Just moving on to our financial projections a little bit. The way that we actually built out our revenue was by projecting out the company's order bookings, which it releases on a quarterly basis. We projected those order bookings out by using the projected end market growth as a proxy for order bookings growth. And at the same time, we also grew their capacity out using CapEx. By projecting out CapEx growth and growth in their growth SG&A, just because the company's capacity is so dependent on the engineering function as well. All of this, combining all of this, we also added in a projection for the utilization rate. And by combining the capacity and the utilization rate, we were able to arrive at our revenue, since the company's order bookings surpassed its capacity every single year. The way we built out our EBIT margin was we actually helped have the company's EBIT grow towards its long-term target of 13%. However, we did have it grow out at a slower rate than the market projects. The market's projecting it to hit that target in 2023. However, we had the company hit that target in 2028 to be more conservative. In addition, just the last thing to note is that another way that we differentiate ourselves from the market is that we believe that the companies will invest more in transportation and will capture a higher share of the electric vehicle automation, and this will allow its revenue to grow faster than the market is expecting. This is just an overview of our discount to cash flow analysis. And what we see here is that looking at our entire sensitivity analysis, there's an upside regardless of what our inputs look like. And it just helps prove our conviction in the company that much more. We also wanted to show our residual income valuation model. What we basically did in here was we linked our condensed balance sheet to this model, and we do realize that this does imply a little bit of a downside, but we think that the DCF is a better way to value this company, just because we think the free cash flow generation capabilities of ATS. The free cash generation capabilities of ATS allow it to return more capital towards shareholders and also invest in growth in a way that excess and then net income doesn't actually point towards. And so we think that focusing on that growth is a little bit more important. This is just a summary of our football field. Essentially, what we see here is that there is upside regardless of what scenario you look at. The differences in the scenarios result from differences in revenue CAGRs over the next 2 years, differences in EBIT margin growth, and also differences in capacity utilization rates. And what we want to highlight is that regardless of what scenario we're looking at, we still see substantial upside, and it helps increase our conviction in the company.
Okay, finally, just to finish things off, our risks essentially are an increase in labor demand, a slow organic growth, a slower expansion of supply chains, and the catalysts are global adoption, industry niche, basically getting into that industry niche that ATS is so famous for, then effective acquisitions. We think these are kind of just important to note when looking at the valuation of the company overall. Thank you guys so much for listening. And if you have any questions, please let us know.
Thank you guys.
Thank you.